Hi guys, and in this video we're talking about what I've learned from investing in over 100 startups. Number one, great ideas don't always mean great results. Because someone has a great idea, there are a lot of other factors which dictate whether they are going to succeed or not. So it's not just about great ideas. Let's talk about the other things. Number two, basic ideas can actually also expand well if they're funded well and they get some traction. Sometimes, number three, a a company with a good idea but a simple idea can grow faster than a company that has 10 great ideas that don't execute on that well. Number four, funding actually really helps because, a good company with a great idea and some traction that doesn't get funding really can suffer and go bust. Number five, know the cycles. In bullish times, profits matter less, and companies can raise money easily on equity crowdfunding platforms through VCs, through super angels, and through angels themselves. In bearish times, profits are pretty much the only thing close to the thing that actually matters. If they're not profitable, they're less likely, unless there's hype value or massive revenue growth. A lot of people might shy away, including VCs and top investors. Number seven, burn rates matter. If a company's burning through cash, no matter how well they raise, they're going to keep having to raise, and they're at risk of a cycle changing or a lead investor bailing out. Number eight, if a company relies on lead investors, they're actually at risk, even if they're profitable. I invested in Meatless Farm that was valued in the hundreds of millions of pounds, and it went bust because the lead investor got cold feet. Next, for myself, dividing my overall target portfolio size into lot sizes reduces loss rates and volatility, meaning I'm not over invested in something I've got super passionate about, but for whatever reason, maybe it's luck or unluckiness or whatever's happened. If you divide your investment into lots, it doesn't matter if one thing's gone bad because you've got lots more. That's why I've invested in over 100 small companies. Another side point on that is I've lost less than 10% of the overall fund in 4 years by using this approach, where I've met other investors that have invested five figures in one company, and that company's got a bust. And guess what? They don't have much portfolio left. I haven't counted my gains yet, and there's reasons for that. When a company doesn't keep you informed, it either means they're growing wildly, or they're doing really badly and they're panicking, or maybe they're even searching around for more funding. Now, in the past 4 years, I've seen all three of these scenarios. When they're growing wildly, sometimes you don't hear from a company for a year or two, or even 3 years. WireX has gone from a couple of million users to over 6 million users. How About has gone from 200,000 users to over 2 million users, and they don't really update the market very frequently. Guess why? They're growing too quickly. They're busy running their business. I've seen companies that are, they're doing badly and they're panicking. They just don't contact you until the last minute when they start to reach out to angel investors. And guess what? That normally means they're running out of money, and VCs and lead investors have already bailed. Next, sometimes you only get a chance to invest once or twice. Why is that? Sometimes they want to float quickly. Sometimes they want to go to VCs like Series A, B, or C, and they don't need to go back to angel investors or private investors. So sometimes you have to make decisions quickly, and you have to invest bigger earlier on. However, next point, down rounds are a thing, and you have to prepare accordingly, whether the company is losing money or expanding their share count because they need to raise more capital. Whatever it is, down rounds are a real thing, especially in an economic down round or down decline. Sorry. You have to expect that sometimes in the private markets, the companies don't grow as fast as they would like to, and they don't bring in profits as quickly as they need to, and the valuation may go down. But that's sometimes a good thing. If you like the company, you could consider investing more. Next thing is angel investing is a massively long gain. It is not going to be overnight. You have to be thinking about these companies over 5, 10, 15, even 20 years. You know, I went in thinking it would be 3 years, 4 years. It's not happening like that. The ones that are growing, like I said, are getting to Series A or B, and they're not looking for an exit probably for another 5 years after that. But the good news is those companies that are growing at massive clip rates, you know, from 100,000 users up to millions, they're going to be valued a lot more in the future. The other thing is it's a liquid. And if you want to actually be able to buy and sell, you should really consider trading other assets. Like with public equities, you can buy and sell easily. Angel investing, it's really hard. Often you have to go and see if the companies are listed on a secondary exchange, and only some angel investments are. I know Seedrs in the UK offer that. I think Crowdcube in Europe, I think they're looking to do that, but they haven't yet done it. Lastly, it's passive, and the chances of you being able to help a company are quite slim. Sometimes they listen to people with experience. I've actually consulted for a couple of angel investment companies that I've backed, but often, you know, that's rare. I've only done that 2 or 3 times out of 100 companies I've invested in. And if you want to be more active and to help the companies grow, probably the best bet is to actually start your own company, even if it's just a micro business or a lifestyle business. You know, you're going to have more impact in terms of growing the company than if you're angel investing, which is pretty much a passive investment. I hope you've enjoyed this list of kind of things to be aware of within angel investing. I guess, developed this experience of investing in angel investing only since about 2020. I got into it because I made some gains by shorting the market in March 2020, and I made some good gains, but I wanted to get out of the public markets because they were going kind of crazy at the time. So I just thought, where can I put it into another kind of asset class that would just kind of take care of itself? And that's when I found angel investing. So I've invested in 100 startups, micro amounts. To be honest, it doesn't really matter how much you invest, because when you're doing kind of the law of large numbers, you know, you're going to have some winners, you're going to have some losers. Whether you're investing $100, $1,000, $10,000, or $100,000 in each business, if you do invest in a lot of businesses, the chances are some of them are going to do quite well. Hope you've enjoyed this video. Remember that knowledge is power, especially the right kind of knowledge, and progress is everything. Make sure to check out my other videos, and I'll see you in the next upcoming video. Take care. Cheers.